Welcome to the December 15th, 2025 Advanced Report for McGowan Group clients. A big week, the Fed cut rates by 0.25%. I'm going to show you some things about that. First, it's not as important as to whether they cut at this meeting or next meeting. There was something extremely important in that announcement. In that announcement, the Federal Reserve, actually, and you can see here the 90-day Treasury going to 3.538%. The current target for the Fed is effectively 3.625, right? From 3.5 to 3.75, and it went to the low end of that range. In fact, we were able to predict that they would cut when that rate actually fell about 3 weeks ago. It started to fall, meaning trillions of dollars in treasuries were actually leading ahead of a Federal Reserve cut, which apparently it leaks out every time they're going to do it. But it went to the low end of that range. Powell said that he thinks, Chairman Powell, soon to be replaced in March of 26. Anyway, he said first that he thinks there are actually more job losses. ADP said 32,000 net new jobs lost in the month of November, according to their private payroll data. So that's a little bit disturbing. I'm going to cover the current jobs and economic numbers at the end of the program because I wanted to see if those concerns were valid. But the T-bill market's telling you that they may cut again because it's not at the upper end of that range. This green line is the 10-year Treasury. We had an inverted yield curve when the long term is below the short term, and that says that the Fed was too tight, but we're now about 4.2% on the 10-year Treasury. That's a much more normal yield curve. But the revelation in this week's report is very important. They had been quantitatively tightening, removing liquidity from the system at $50 to $100 billion each month. Well, they've reversed that and they're into quantitative easing. They said they will buy treasuries as needed. That was a surprising change, and it begs the question, what is the Fed seeing that we're not seeing? December 16th, very important date. Finally, the Bureau of Labor Statistics, Bureau of Economic Analysis, they're 3 months behind, and they're finally going to catch up December 16th, which happened to be after the Fed meeting. So tune in next week. Be sure to subscribe because, hey, we're gonna get a lot of data all at once, October, November, and some new data for December. All right, big trading action this week. It's a huge shift underscoring our deep value premise for the portfolios. This is the Dow Jones Industrial Average. Made a new high, almost 49,000 on the Dow. I remember, back in the crisis, it was like 6,000. Anyway, if you take the Dow and you want to do an accurate forecast, it seems like for any reasonably long time period, just give it about 6%. And that's how you end up triangulating when the Dow gets to maybe 100,000, right? Anyway, this was strong for the Dow. And it lasted, as you can see, the final 3 trading days of the week. Now, what happened here? Technology went into a sell-off. Actually, the Magnificent Seven down nearly 3% for the week. And Oracle had great earnings, plus 54%. I'm doing the market reports on WBAP and KLIF, and all of a sudden I see, wow, that's a great earnings report. Boom. They got hit this week by 12% at a great report. It's starting to happen where tech companies, Broadcom got broadsided for the same thing. They beat expectations and they still sold off by 10%. There's something going on here, and the premise appears to be AI mania, right? The premise appears to be that OpenAI may not be able to raise enough money because even their projections say they're not going to make money till 2030. So in this arms race for AI, the big spending is being called into question, especially at these high multiples. So tough week for Austin-based Oracle. All right, but we go for the last 10 years. I wanted to see what companies in the S&P made the most money over the last 10 years, right? Shocking. NVIDIA, 225 times the price 10 years ago. Advanced Micro, 90 times. Axon Enterprise, I didn't even know who that was, 32 times. Broadcom, 32 times. Tesla, 30 times over the last 10 years. Arista Network, Lam Research, Quanta, and KLA. KLA makes the equipment to fabricate chips. So it was all about technology for 9 out of the top 10. A little surprise here, Texas Pacific Land, 20 times, a 20-fold gain in 10 years. Now, I did the worst performers, PG&E, that's Pacific Gas and Electric out in California. It doesn't tell us that much because the worst performers actually got kicked out of the S&P for bad behavior. All right, now, retail sales and the jobs market. This is important. So for 2026, we've been telling you that energy infrastructure looks great, dividend companies that are underpriced look great, and there are even some sectors of tech that are not grossly overvalued, that are actually a bargain. And we'll continue to rotate those into the portfolios. I'm Spencer McGowan, your financial weatherman and president, McGowan Group Wealth Management. We serve affluent families right here from the Crescent in Dallas. Our dedication, the team of 10, McGowan Group Wealth Management, busy all week long, bringing you the research you would expect from your wealth manager. You can find us at networthradio.com, and actually you can contact us there and set your time to update your plan. What's this? Retail sales. So I wanted to see, are there any trouble signs in the economy for 2026? And we'll cover more forecasts next week as well. But look, 2026, or this is 2025, ending numbers for retail sales, but notice we only have September. That's why December 16th, you're going to get a whole bunch of data all at once. But this chart looks just fine, right? Retail sales, 9% increase over last year. According to American Express CEO, he said, hey, we did 9% better than last year. That's consistent with Black Friday and Cyber Monday, both up right around 9%. This is job openings. Now, when you get into a recession, job openings go way down. And we've basically been stable at about 7.7 million jobs posted to be filled. So that is stable, and that's just fine the way it is. If you see that number come down, then you've got to prepare for the potential that the economy's way slowing. This is interesting. Weekly jobless claims. We just had a number that was the lowest number of weekly jobless claims in the history of this statistic. And it bounced back up to about average, maybe a little bit above this week. What does that tell us? There's not massive unemployment filings. So next week we'll break down what we finally learned about October, November, December, because those two bureaus have been, let's say, protesting the shutdown by not delivering any data, which is actually their job. Thank you for tuning in. Find us at networthradio.com. The McGowan Group stands ready to serve. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.